Brett, just give me a bit of a read then on what you make of the very strong, potent move to the upside that we've seen in global markets overnight.
Well, it's very impressive. I'm very encouraged by the move in China overnight. The pretty big rally, just under 6%. And then with the move in the U.S. on the back of it this morning, seeing the FANG stocks lead the way again. I'm a little bit cautious of the U.S. rally. I think we're quite extended. You're seeing some euphoria here. The retail investors are chasing a lot of the mid cap, low cap names, micro caps, which is a little bit symbolic of chasing a top. So as much as I don't like to see the extension of the FANG stocks, it's probably a little bit better to see those the real names being taken up here rather than the speculative names. But as I said, the encouragement that I see is really the beginning part of what I think is going to be a really big rally in the Chinese market. I've called for this for quite a long time, and it seems like we've really made a huge stride overnight. I think the momentum will start to pick up and people will start chasing there as well.
Can you justify the differential in terms of the speed of the China market rallying at such an exponential rate relative to the U.S.? Is the velocity in this rally justified?
Well, look, I think velocity is something that, we always try to figure out what it really means. What I think in the Chinese move that's really impressive is it's somewhat counterintuitive when people are looking at how Hong Kong plays into it. A lot of speculation around politically what's going on between the U.S. and China on the Hong Kong side. It looks like it's really almost a nationalistic tone that we're taking. I said earlier on Bloomberg News, it's like the Summer Olympic for stocks. Everyone's trying to do their best to outperform here. And in the China move, I think it's really lagged. I think if you look at it, maybe not correlated to the actual bottom to the top, but where we are in historics, we're 5 years away from the 2015 high. We still have quite a long way to go back to 5,100, whereas NASDAQ is setting new highs every day. That's the thing that's really encouraging to me is I think we've got a long way to go to get back to those levels. So I look at more from the distance to travel up rather than where we've come off the bottom.
Brett, the folks at BNP Paribas did an analysis of the impact of lower Treasury yields on the U.S. equity rally. And what they've concluded is that the drop in U.S. 10-year specifically since the start of the year has boosted the S&P 500 to the tune of about 25%. How much more of a foundation can the lower yields provide for the U.S. equity trade going forward for the second half of the year?
Well, look, I've often been trying to figure out how really the rationalization works here, because you've got zero or negative rates, around the world, and people are being forced into other asset classes, and I think that's what the BNP strategist is talking about. So very low yields in the U.S. is forcing people into the stock market, and people are chasing. I don't really know. I don't really think that continues in the U.S. I do think you see asset allocation away from U.S. dollar-denominated and U.S. assets and U.S. stocks, and I think it broadens out into China, as I've said many times. What I do think is really going to be interesting to watch is when we get some sanity back in the market and actually fundamentals kick in and people look at yield. Yield is not going to be found around the globe in any market except the Chinese bond market. And I think that's where you get a huge asset allocation. So I don't think that phenomenon is enough to buoy stock to really put a huge underpin underneath the U.S. stocks. I do think we'll see asset allocation away from that. And I do think it will trickle into the Chinese bond market as well as the Chinese equity market.
Okay, Brett, we'll pick up some of those thoughts on the bond market in China in just a moment. Brett McGonegal stays with the Daybreak Middle East team. Much more to come on China, the numbers, bonds and equities. This is Bloomberg. Hong Kong has given its police sweeping powers under China's national security law, adding to tensions over the city's future. Everything from warrantless searches to online surveillance and property seizures are now in effect. The Secretary of State, Mike Pompeo, says the death knell for Hong Kong's autonomy.
This is going to end up just being another communist-run city. It's unfortunate Hong Kong was such a special place where there were all of the freedoms that the people of Hong Kong were promised by the Chinese Communist Party.
Big Tech has also pulled out of the city on notice, put the city on notice, I should say. Microsoft joining Google and Facebook and Twitter in saying they will no longer process user data requests from the Hong Kong government. Brett McGonegal is Capital Link Chairman and CEO. He's still on the line. Brett, so you make the point that the markets are almost divorced from the politics, from the nuances of what Mike Pompeo says Hong Kong might become. And we're in the National Olympic sport for markets, equities and bonds. I want to focus in on the bond market. We saw quite a dramatic move in the Chinese bond market yesterday, one of the biggest moves since 2016. Now, you say we're going to allocate capital, and it's going to be a momentous allocation of capital to the Chinese bond market. So are we at the start of that? And can you put that in context for us? This was one of the biggest moves in the bond market, as I say, since 2016.
Yeah, sure. So, I mean, the context, I think, is pretty striking. So if you look at where, if you were to use a benchmark on the index, you would probably use either the SDR basket or you'd use the Bloomberg Barclay index. And that would make Chinese bonds about a 12% holding of a global portfolio. So if you use that as a baseline, you need about $1.5 trillion of Chinese bonds needs to be bought by managers to get to what we would call equal weight. Right now, that would be 12% of the portfolio. You look at the Chinese bonds are owned by less than 3% of the market is owned by foreigners. So if $1.5 trillion of bonds to be bought to get to benchmark equal weight is a pretty significant amount. And I think that we're just starting. So what we've done is I think you've seen a crossover and you've seen validation for the first time in February when you had flight to safety out of U.S. dollar-denominated assets. And that set off, I think, which is the first real cross where you get the validation and people say, okay, this is now an asset class that global managers are willing to own. It's not that easy to own right now, the index. So that's probably the last stumbling block. However, when you then compare it against yields and look at where yields are in the world, they're negative or zero around the world. And you look at the Chinese market and you're above 3%. So I think the idea of just the perception that's there to be bought, the crossover and the validation, and then going to actual yield, which, bond managers need yield. They can't buy zero yielding bonds. So I think that's the last point, and I think it goes for years.
Brett, let me just get to a reaction from you on the geopolitics, because Hong Kong is a gateway for global capital. I look at what is happening in terms of actions on the ground. I listen to the rhetoric from officials from both sides, and it is something to be concerned about. When does the market start pricing that higher risk in?
So I think it's concerning. The headlines certainly don't read well right now. I think it's a new norm, and I think that people will begin to get more accustomed to the fact that the jawboning and the headlines are really not that's not what's going to drive the actual policing in the daily life in Hong Kong. There's a lot of overreaction right now to, I think, the fear of the unknown. So I don't want to get too much of a deep dive into the political side, but what I do think will happen is you will start to see, I guess for lack of a better word, decoupling of the U.S.-China, the way that asset allocations have been happening and the way that political capital flows, and you'll get more of a nationalist play. And I think what you will see is that this will actually not be a detriment to the market. It will be a beneficiary, and it will look like as you see Chinese listed equities starting to dually list or either drop their listing in the U.S., delist in the U.S., and then list back in China, or do a dual listing in Hong Kong, those things all play into a different sentiment play. And it actually, I think, balances the two markets between China and the U.S. in a way that we haven't seen before, which so you get the decoupling, you get the rebalancing, and you'll see capital start to flow. But I think what really makes the difference on the fixed income side is the yield. And yield can just – money needs to find yield. And it's not really going to pay a huge amount of attention, I think, to political headlines. It will pay attention to where the yield – where money can find yield, and that's currently where it is.